Good afternoon, everybody. Today, we're going to be doing a deep dive into different CECL methodologies. We're really going to be focusing on the different types of models that you can use under CECL. We're going to talk about warm models. We're going to talk about vintage or life cycle based models, reporting period models. We're going to kind of talk through what are the primary assumptions and drivers that are used in different modeling. We're going to look at differences and similarities between models, and then kind of understanding the benefits, the trade-offs, and even some of the cons of different models and which models may fit best for different types of institutions, or even based off of the complexities of different portfolios. So first, to kind of start off with, we're going to talk about considering methodologies, how to go through that process of determining which model or methodology may be the right approach for any given loan pool. We're going to focus on discounted cash flow models. We're going to look at those in both the reporting period context and that life cycle or vintage context. We're going to discuss probability of default models, the weighted average remaining maturity or WARM model. We're going to talk about economic forecasts and how those are utilized in different models, and then talk a little bit more about the implementation and governance of these models as you're moving forward now and have been with CECL for a good few years at this point. So first thing is these kind of methodology considerations. So determining, which model really may be the best fit for our institution, or again, maybe for different pools, right? You don't have to use the same exact model across all portfolios or all loan pools as you work through this. And a lot of this comes down to a couple different key items. First thing is data availability, right? How much data do we have access to? And going further into that is, do we have loan level data or do we have summary level data? Loan level data is really kind of the gold standard here. If you have loan level data and that loan level data is accurate, most methodologies are pretty much open to use. Now, do you have enough actual events? So maybe you have like a real estate pool that doesn't have a lot of charge-off events or default events. Well, maybe a PD model doesn't work perfectly for that. Having the loan level detail really opens up the ability to use most models versus that summary detail. And summary detail can kind of limit which models you can ultimately use as you start to kind of make those choices. So again, kind of that key distinction. Do I have loan level detail going back in time? Or do I have summary level detail? Or do I have a mixture of both? And we'll talk through how to kind of assess what data you have and which models may work best. The second thing here is then the complexity of the portfolio, right? So under CECL, we're supposed to be grouping assets with similar risk and then building kind of this pool-based risk structure. Certain portfolios may be more complex than other portfolios, and the complexity may require a more stringent or more detailed allowance calculation. So understanding the complexity of your portfolio also here is going to have an impact on which model you're going to end up choosing. Simpler models may not be the best fit for a complex portfolio. The size of your institution, right? Smaller institutions generally are going to use simpler models than larger institutions. The time requirement, the complexity, all of that kind of impacts institutions as they grow and become bigger. And then lastly, the segmentation, right? How are we looking at risk from a segmentation perspective? That can also impact which model you're going to choose. Like I said, you don't have to use the exact same model for every loan pool that you have. So depending on your different pools, you may select a warm model, for example, for a very simple pool, and a discounted cash flow model for a pool that's larger and maybe more complex. All right. So there's a bunch of different methodologies, right? The CECL standard didn't say you have to go use this specific methodology. Now, they gave us a few examples of methodologies that you could use. What we have here are really kind of the most commonly used models, whether you're with ARCSys or with another solution. So again, we have the discounted cash flow models, we have probability of default, we have vintage analysis models and more models. All of those are available within ARCSys, and we're going to focus on some of those today and go through the assumptions that are used in those models. You also have other models like the loss rate method or a roll rate method, which are generally simpler models, but are also optional to be used under the CECL guidance. All right, first question for today. Which three factors should an institution consider when selecting a CECL methodology? Regulatory preference, marketing budget, interest rate forecast, data availability, complexity of the portfolio, size of the institution, the geographical location, number of employees and historical stock price, or vendor cost, management's favorite model, and historically odd findings. Which one of these is some of the factors you should be considering when selecting your CECL methodology? Okay, very good. Everybody answered that correctly. That is correct. The correct answer is B, data availability, complexity of the portfolio, and size of the institution. Okay. moving forward. So the first methodology we're going to talk about today is the discounted cash flow methodology. All right. So a discounted cash flow model is really a model where you're using charge off and prepayment expectations to build adjusted cash flows of your loans. What this does is it basically looks at the contractual cash flows that you would have based off of, your principal and interest payment amount, the maturity date on the loan, the rate on the loan, and it discounts those cash flows back to present value using an effective interest rate and discounting the expected payment amounts that you would receive based off of those expectations for charge-offs and prepayments. Now, the formula here to calculate the allowance is very simple, right? We take our amortized cost basis, we subtract our present value of the adjusted cash flows. Now, I guess I will talk quickly about amortized cost basis. So remember, under CECL, we should be using the amortized cost basis as this measurement of the allowance. That amortized cost basis should include things like deferred fees and cost, premiums and discounts on purchased loans. It potentially can include accrued interest. However, accrued interest is the only one that I just listed out that can be excluded through the use of a practical expedient. But all of those items, deferred fees, deferred costs, premiums, discounts, those are all used to calculate the effective interest rate, right? If I have, let's say I'm receiving income of $100 this month, but I have costs associated with that. So I've got $100 of income, but 10 of those is cost. Those are cash flows that adjust the actual interest income that I'm receiving. And therefore, we use this effective interest rate in order to calculate what the actual cash flows received are with these additional ACB items. So a lot of times, as we do validations or as we work with our clients to onboard them, we always kind of go over these additional ACB items because they really do have an impact in a CECL allowance calculation and your expectations of the cash flows you'll receive. So I wanted to bring that up. It's an extremely important concept that we always want to mention to make sure that institutions are considering those deferred fees, costs, premiums, and discounts in their calculations, as is required by the CECL standard. Now, the data you need generally to run a discounted cash flow model would be loan level data. Now, the main reason for the loan level data requirements is to get your expectations of prepayments. You also need those loan level data points to calculate the future cash flows on each individual loan. So this is a model that is generally run using loan level data. If you try to build a discounted cash flow on summary level data, you have to really build in a lot of assumptions so things like you may have to come up with a weighted average interest rate or a weighted average payment amount. It becomes very kind of fuzzy what you're actually expecting your cash flows to be at the loan level if you try to run this model at the summary level. So loan level data generally going to be required to understand contractual terms, balances of each loan, interest rates, payment amounts, and again, all those different items like deferred fees, costs, premiums, and discounts associated with loans at the loan level and impacting those loans' individual cash flows. Now, the two key assumptions in this discounted cash flow model are going to be charge-offs. So what is our expectation of charge-offs moving forward? These are generally built off of historical data, whether your own historical charge-offs or third-party charge-offs. The same is true for prepayments, right? We're adjusting our expected cash flows for expectation of charge-off and prepayments. So we also have to have prepayment assumptions built into the model. Again, for our clients here at ARCSys, those prepayments are generally built off of their own institution-specific prepayment data. However, you could potentially use third-party prepayment expectations as well. Now, one thing to keep in mind, if you're not using your own institution-specific charge-off or prepayment data in your model, is you're generally going to have to do some sort of exercise that looks at your own charge-off rates or assumptions versus what you're building in the assumptions within the model to make sure there is not some huge discrepancy between the two. And what I mean by that is, let's say we have let's just say a consumer secured portfolio, and we're building in an expectation of charge-offs using third-party data that is a 1% annualized loss rate. But our own annualized loss rate is 3%. That would generally draw some sort of concern that the third-party data you're using is not reflective of your institution-specific risk, and therefore most likely needs to be adjusted through the use of qualitative factors. And we'll talk more about qualitative factors here in a few. As we go through these different models, it is a key distinction if you're using institution-specific risk or third-party risk. If you're using that third-party risk assumptions, you do need to periodically do assessments to ensure that that third-party data is in line with your own institution-specific risk. And if not, that third-party data is adjusted to be more reflective of your institution and your management's expectations. So kind of, again, key assumptions in a discounted cash flow model are the expectations of charge-offs and prepayments. The discounted cash flow method estimates credit losses by projecting future contractual cash flows and then discounting them back to the present value using which rate? Market interest rates, federal funds rate, prime rate, or the effective interest rate? And again, this goes back to those items like deferred fees, deferred costs, premiums, and discounts that impact the expected interest income one may receive. Okay. Effective interest rate is the right answer to this, right? We are calculating an effective interest rate based off of those additional ACB items that impact the interest income that we will receive on these cash flows. Very good. All right. So discounted cash flow models at ARCSys, we run two different types. We have reporting. Well, I should say we actually run three different types of discounted cash flow models. You can run discounted cash flow models, whether you're looking at reporting period data, which is that kind of month to month activity, or you can also run discounted cash flow models kind of from a vintage based approach or a life cycle approach. So vintage, life cycle, same thing. Now we're going to start with reporting period models. Reporting period models, what we do is we look at, again, that month to month activity through time. So very similar to what we used to do pre-CECL in the incurred loss model, right? We'd have our look back window of monthly losses. We'd have come up with our annualized loss rate, and we'd apply that for the allowance calculation. Under CECL, you're still looking at a period of time for charge-offs, but now you're also looking at a period of time that is representative of risk for prepayments. So you've now built in one other new assumption based off of where we were prior to CECL. And again, this data is then used to build our future expectations. Now, you could use, again, your institution-specific risk, or you could be using third-party data. Either are technically available and appropriate to use. One just needs more consideration. That third-party data, again, does need additional analysis periodically to ensure the third-party data that you're using is in line with your own institution-specific risk. For most of our clients use their institution-specific data unless they maybe don't have a lot of data. They have a new pool, and then they do typically use third-party data for their assumptions when the data is either missing or limited. Now, we have different types of models here at ARCSys. We have what we call our nonlinear discounted cash flow model, which is more of a machine learning model. What that machine learning model does is it learns from your historical data. It incorporates market forecast or economic expectations, and it builds out projections over a reasonable and supportable forecast period. Now, with any of these models, remember, there is this forecast component and a reversion component. So if I'm forecasting 12 months into the future, I should have projections for both charge-offs and prepayments 12 months into the future. But that doesn't mean after the 12-month forecast period ends, I get rid of all my charge-off and prepayment assumptions that would be utilized. What happens under CECL, and again, based off of the language within the standard, is any point beyond the forecast period, you revert to the average of the historical data you're using, whether adjusted or unadjusted through qualitative factors. So we have a period of projections, and then we move to our reversion rate, or the average of the historical data we're feeding into the model. Now, with those reversion rates, if qualitative factors are built into the data, you would adjust your historical data up or down. You can also add on qualitative factors on top of your calculations in a discounted cash flow model. Now, what happens in the application of this is the projected loss rates, prepayment rates, as well as their reversion rates are applied to the cash flows of every asset within that pool until the loans basically pay down to zero. And this results in that adjusted cash flow stream. So, right, we can take a present value of the contractual cash flows. What CECL does is it takes a present value of those adjusted cash flows, building in the expectation of loss risk and prepayment risk. And very simply put, the calculation is just any loan's current amortized cost basis as of a given monthly period minus the effective net present value with these adjusted cash flow streams. Now we also, or I guess, sorry, I'm getting ahead of myself. What we have here is historical periods in a forecast. So everything in blue, that is our actual monthly historical losses from 2013 through 2019. So that's the period of time we're feeding into the model for the model to learn from. We're saying, hey, management believes the charge-off risk from January of 2013 through December of 2019 is the best expectation of what we would expect to see moving forward. So we've got this kind of long cycle building our expectations of future risk. That ultimately will be our reversion rate. And you can see that yellow circle up at the top, average observed loss rate of 0.47631%. The monthly average of that historical data is 0.47%. That is our reversion rate. We also have this red line here at the end. That's our projections, right? So we're projecting charge-offs to look like this over the next 24 months. I think we have in this example a 24-month forecast period. So you have two things happening here, right? You have the selection of historical data, which again is management's best expectation of what future risk will look like. And we have our projections. Now, in this next example, we've built in an adjustment of 150% to show what qualitative factor adjustments would look like here. Now, if you remember, I said the average of that historical data was 0.47%. That was unadjusted. With 150% adjustment, my monthly average is now 1.19%. So again, this goes back to my third party example, right? If we are using a 0.5% or a 0.47% historical average for our losses, but our actual losses are significantly higher, this is where you have to build in those adjustments, right? You have to make the model more reflective of your institution's actual risk when you're using third party data. You may also have data that's not reflective of current risk as well, right? You may have your indirect auto pool. It's seeing losses that are higher than any period historically that you've had, and therefore you have to adjust your historical experience to be more reflective of your current experience. This is where qualitative factors come into play and can be so important when getting your assumptions reasonable within your CECL calculations. Now, one other thing I want to note here, and we'll kind of focus on the top part of that red line forecast value, right? When I built in this adjustment to my historical data, I'm now projecting at its height a little over 1%. When we go back to the graph before with the unadjusted data, I'm below 0.5%. So this does two things, right? It increases my historical average when I build in an adjustment, and it also increases my projected forecasted values as well. So when you build in qualitative factors into the model and adjust the data you're using, it does both things, right? It adjusts your forecast and it adjusts your reversion rate. When you build on qualitative factors outside of the model, you're basically just building in basis point additions to the calculation you're already running with your forecast and reversion rates. So is there a better or right answer? Maybe not, but definitely by building in the qualitative factor adjustments within the historical data itself, you get that qualitative adjustment run through the actual future expectations, runs it through the life of the loan versus building on an add-on on top of it after the fact. Now we do a similar thing for prepayments, right? We've got our historical data, we've got our prepayment assumptions historically, and then we have what the projections look like. So in a discounted cash flow model, you have, again, kind of these expectations for charge-offs prepayments, whether they're the initial forecasted expectations or the reversion rate expectations. These are items that also need to be reviewed and considered when selecting a methodology, right? Is that period of time I'm feeding into the model the best expectation of risk I would expect to see moving forward? If not, is there potentially a better period of time that I need to utilize? Or do I need to build in qualitative factors to my model to make the risk more reflective of what my expectations are? All right. We also run what we call a linear discounted cash flow model. And this is more of an averaging model. So, right, the nonlinear is more of a machine learning model. The linear is more of an averaging model. It's just a little bit simpler. It's generally better for pools that have limited or less historical events, right? So maybe a commercial portfolio that sees charge-offs every couple years. Maybe a linear model is better for that because it's an averaging. It averages out that long-term risk versus a machine learning model where you have constant events. You're seeing charge-off activity every single month. Generally, a machine learning model or that nonlinear model is going to be a better choice. So the linear model works functionally pretty much the same thing with the expectation of one item, which is the forecast, right? You're still building in charge-off assumptions, prepayment assumptions. The difference is the machine learning model, the nonlinear model, is going to run through a machine learning statistical model and build out kind of monthly projections, where this linear model is going to build out averaging projections or more of an average expectation into the future. And like I said, that generally works better with pools with limited data. You can kind of see this here. So, right, this is the same historical data we were looking at before. And now we see a much flatter expectation of charge-offs. Or when we look at the prepayments, we see that very flat expectations of prepayments in the red line. So what it's doing is it's just averaging its projections a little bit more than the nonlinear model, or significantly more than the nonlinear model. So that linear model, averaging model, when we have the historical data, our reversion rate piece is the exact same between the two, right? It's the exact same historical data, whether adjusted or unadjusted. So my reversion portion of the allowance calculation is the exact same. It's still using the same average historical data. What's different is the forecast piece. One is forecasting averages, and one is forecasting more up and down events. And I think this prepayment graph is really good, but I'm going to go back to the nonlinear in a second. But again, right, we see this very kind of flat line of projections for prepayments. When I go back to the linear model, right, you see more of these ups and downs in the projections, more in line with what your actual history looks like, right? Generally, we don't see very, very flat trends historically. You get periods of higher prepayments or higher losses and periods of lower. And the nonlinear model kind of does a better job replicating reality, where the linear model does a better job of kind of averaging expectations into the future. Again, not to say one's better or worse than the other, but the linear model generally does work better with lower volumes of events historically. The nonlinear model generally works better when there's more events. So those are kind of items you can consider when determining the methodology between the two, right? How many events do I have in my portfolio? What's the complexity of the portfolio? And generally, the linear model would be one you would use in a less complex model that has less events through time, where the nonlinear model you would choose a more complex portfolio where there's more events that it can learn from through time. All right. We also have life cycle discounted cash flow calculations, and this is our vintage-based approach, right? So we're no longer going to be looking at that kind of month-to-month activity as of a given monthly period. We're now going to start to consider, how do things look like by their different vintages? And this kind of captures the changes through time of a loan, right? So the core concept here is still the same, right? We're still inputting net charge-off and prepayment data, but these are now going to be aggregated by month after origination and for specific vintage years, right? Specific origination periods through time. Now, this specific lifecycle DCF model really needs that loan level detail to be run. Like, you can't go pick vintage periods based off of summary level data, not with any kind of robustness or accuracy. So this one does require more loan level detail historically, not only today, but also historically. And it is the most complex of the three different discounted cash flow models, because we're starting to look at things by vintage now. Now, we're again going to be building in, like I said, those different charge-off and prepayment historical periods, but by vintage. And the model's again going to project charge-offs and prepayments, but instead of projecting it, month over month through time, it's going to now project by month after origination. So it really starts to hit this whole life cycle approach, the allowance over the life of the loan, and you start to kind of see different cycles in the way things behave as they age. The other kind of great thing about vintage-based models is it can really kind of let you isolate periods of time when you're originating loans. So where this can be beneficial is if you do things like underwriting changes. So maybe you tightened up underwriting and then you loosened it back up, more similar to where it was beforehand. It allows you to say, hey, look, the risk we're putting on originations today is more in line with the loans we originated prior to tightening up underwriting and then going back to loosening it. We think that period of time may be a better reflection of our current risk because of the changes to underwrite, right? It doesn't just have to be underwriting. It can be a lot of things, just different internal or external risk changes based off of when things were originated. And it can really, again, kind of help you narrow down and define what historical risk maybe is the best expectation of the risk you have today, especially when those different vintage periods are similar in risk to what you may be capturing today. Now, there are a couple different things here that we want to go over. In a vintage-based model, the first 1 and 2 item you see here, expired term versus period 0, are really important. What expired term does is it treats loans based off of where they are in their life. And we'll go through the example here, right? If I have a loan that is 12 months old and I'm forecasting 24 months of expectations of charge-offs and prepayments, instead of using that full entire 24 months, it's going to start at month 13 of the projections, right? The loans, because we're looking at everything by month after origination, I've got a loan that's now been on the books for a whole year. I'm not building its forecast starting at month 1. I'm starting the forecast at month 13, 1 month after where it currently is. So it builds in kind of that, again, life cycle approach where as loans age, they experience different risk, and therefore you're assessing it differently based off of where it is in its life versus treating every loan the exact same, right? Because of how we're projecting things in a vintage-based model, we can then treat loans differently based off of where they are in their life. Something we cannot generally do with a reporting period model because we don't have the data at that more granular level. So expired term is the option that will treat loans based off of where they are in their life. Now, there's also this period 0 option. Period 0 kind of removes that concept and treats all loans the exact same. Meaning if I'm forecasting 24 months and the loan's already 12 months old, it doesn't care about where it is in its life. It's just going to run the entire forecast and then move it to the reversion. So it treats every loan the same in regards to the assumptions that you're building in. Meaning and I'm going to explain this better when we get to a graph here in a second, at least with a visual aid. But you do have those options when running these life cycle models, either expired term, treating a loan where it is in its life when building in the assumptions, or period 0, treating all loans the same. And the period 0 option can be a really good tool to use if you're having a period of maybe let's say you're having significant growth and you've taken on more risk and you think that charge-off assumptions maybe are going to be higher than they've been in the past. That period 0 approach can give kind of a more conservative approach to what your expectations of losses are if built in the right manner. The expired term, though, option does again kind of consider, hey, my loan's 36 months old. It doesn't have the same charge-off expectations as a loan that has only been on the books for 3 months, and so on. Now, again, we have our reversion rates. So the difference here is that reversion rate is the long-term average of that charge-off cycle you're feeding into the model or prepayment cycle versus the kind of monthly average like we were talking about in the 2 different models prior to this one. And again, the discounted cash flow calculation is the same thing. We take the current amortized cost basis minus that effective net present value. So in all 3 of these different discounted cash flow approaches, we're running the same calculation, but with different historical inputs, different historical inputs between the life cycle models and the reporting period models. And then all 3 of them have different projections. And again, part of the goal here is always going to be, is that historical period I'm building into the model a good representation of risk? If our answer there is yes, step 1, we're starting with building in good historical data that matches our expectations of risk. The second thing to ask then is my forecast in line with what we're expecting to see moving forward? If my answer there is yes, then generally the last answer to the question, which is the allowance reasonable, will also be yes. But those are the types of questions we have to ask ourselves in a discounted cash flow model. Are my charge-offs reasonable? The historical data I'm feeding in, same with prepayments. Then review our forecast. Are our forecast in line with what we expect to see? And then lastly, is the overall allowance a reasonable expectation of losses over the life of the loans on the books today? So this is a graph of charge-off projections for a vintage-based model or this life cycle discounted cash flow model. What we see here is a cumulative loss curve. And you can see at the top there, I have 2010 through 2013. This is the loss curve of the loans originated in 2010 through 2013, cumulative. Now you'll see this stretches up to about 4.25% by the end of its life. So overall, what that's saying is for this pool, for the loans originated from 2010 through 2013, we charged off about 4.25% of what we originated. Okay. So again, understanding the data you're feeding into the model, what those assumptions are and what the projections are, help you understand, is the model a good fit for this pool? The second thing to note here is instead of looking at everything, if you notice on those reporting period models, we were looking at monthly activity. Now we're looking at activity by month after origination. Now, I think we did this off of an auto portfolio. One of the things you're going to notice, right? There's very little charge-offs up front, which what we expect. We generally don't charge off loans 2 months after originating them. But by the time we get to 6 months in, we start to see these charge-off events and we start to see that cumulative loss curve start to grow. And we really see the bulk of that activity happening from about 6 months to about 36 months after the loans originated. By the time they get out to about 40 months, we're going to see that loss curve flatten off. And this was that explanation I was trying to get over on loans risk changes as they age, right? As a loan that has been on the books for 48 months, at least in this scenario, I would have a much lower expectation of loss than a loan I put on the books 5 months ago. And vintage models help really capture that evolving risk as loans age And depending on whether you're using period zero or expired term, you can also influence how the model is handling the seasonality of the loans in your portfolio in a given reporting period. Now, I'm going to go back to that period zero expired term. In a period zero application, the full forecast would be given to every single loan over the next 24 months, and then it would move to its reversion rate. In an expired term scenario, a loan that has been on the books for 12 months already is going to start the forecast at that 12-month marker moving forward, then move to its reversion rate. A loan that's been on the books for 30 months is going to move directly to the reversion rate, right? So it's treating things differently based off of where they actually are in their life. Period zero does not do that, and it just feeds the entire forecast, then moves to the reversion rate on every single loan. So you do have options. And again, there's just different ways to consider the risk of a portfolio and the settings within a vintage-based discounted cash flow model like this. Reporting period models, a little bit simpler. They don't have those types of bells and whistles. So you don't have to consider something like this in a reporting period model because you're not looking at things by month after origination. But in a vintage-based model, understanding how vintages behave as the age becomes more relevant and important to your calculation. Same thing we do here for prepayments, right? You can apply that period zero expired term application to prepayments as well. And we again see here that we have this period of high prepayment or prepayments on these loans. Eventually, by the time we get out, now this is a little bit longer out into the future, right? We saw the charge-offs kind of flatten out and the expectation of charge-offs really decrease around 42, I think, 45 months. Here, prepayments kind of last out longer, right? Our prepayment cycle is different than our charge-off cycle. Our charge-off window is a little bit shorter than when we see prepayments within this given portfolio. So I bring that up because it's not, the life of these things is different depending on which dependent variable you're looking at, right? So if I'm looking at charge-offs versus prepayments, the activity that we observe by month after origination may not follow the same cycle. One may last a little shorter than the other, one may last a little longer. But those are important considerations to not only understand how the data behaves, so that you can make sure that the assumptions you're building into your model are reasonable. Right? Understanding kind of the seasonality of loans, how different variables behave as things age, just makes you build better models as far as that goes. All right, question 3. For both linear and nonlinear DCF models, what is the reversion rate and when is it applied? The current interest rate applied to the current balance, maximum historical loss rate applied to highly delinquent loans, the average historical loss and prepayment rates applied beyond the reasonable and supportable forecast horizon, or the predicted rates applied only during the forecast horizon. What is the reversion rate? What do we revert to after the forecast period ends? What do we revert to? All right. The correct answer was C, the average historical loss and prepayment rates, right? This comes directly from the CECL standard. Any period of time after the forecast period ends, you must revert back to the average of the historical data utilized. So we're reverting back to our historical assumptions after our forecast window has ended. Again, if you're building qualitative factors in your model, and adjusting your historical data, that reversion rate includes your qualitative adjustment. If you're adding on qualitative factors outside of the model, your reversion rate does not include the qualitative factor. Moving on, next we're going to talk about probability of default models, so PD models. In a PD model, we're going to be looking at different things, right? A different methodology with different assumptions. Now, there are different ways people can run PD models. I'm going to focus really on how we do them here at ARCSys. We do run, again, a vintage-based probability of default model, which means we need loan level data historically in order to look at defaults by different vintage periods. So loan level data is a requirement really for some period of time in order to make a probability of default model work. Now, there's 3 different things we look at. We look at the expectation of default. We can measure defaults in 2 ways. We can look at the dollar amount that's defaulting in a given pool, or we can look at the units or the number of assets or loans in a pool that are default. They will give us 2 different answers, right? If I look at the dollars compared to the overall dollars in a pool versus the units delinquent compared to the overall units in a pool, I will get 2 different default rates, almost always. Where this can be important, right, is especially probably the area where we see the biggest discrepancies between unit default rates and dollar default rates is probably in commercial portfolios, right? If you have one commercial portfolio or one relationship go in 90 days delinquent, If it's a $20 million relationship, it may have a very small impact to your units in default, but it may have a much bigger impact to the dollars in default. So it just kind of matters. Again, understanding your data, understanding the defaults goes into selecting the more appropriate choice for a given pool. But like I said, you will have different rates or default rates depending on you're measuring it in dollars over units. I would say in most cases, generally, the dollars approach is a reasonable approach and is probably the approach most often taken. However, the units model is and can be more appropriate in certain instances where units and default have maybe a bigger expectation of risk, especially in those types of portfolios like commercial, where one large commercial loan going into default may have the impact that it does. Now, we also have loss given default, right? So that is the percentage of loss incurred if default occurs. I go through a quick example on loss given default, but if I have a $10,000 balance prior to charge off, I charge off $10,000, my initial loss given default is 100%. But if I recover, let's say $4,000 10 months later, and I now have a net loss of $6,000 to my $10,000 before charge off, I'm now at a 60% loss given default. So it's just measuring how much are we actually losing on this compared to the balance prior to charge off, including the net of recoveries. All right. So PD models, like I said, these are vintage-based models again. So we're going to be looking at things by month after origination. Instead of building in expectations for charge-offs, though, we're now going to be feeding in default activity by month after origination and building in expectation that a loan is going to go greater than 90 days delinquent. Additionally, we have our reversion rate. So you're going to have a period of time where it's projecting default expectations, and any point beyond that period of time will revert to the average historical default rate. Now, what a default model does, though, instead of applying a default rate to every future cash flow, it finds the highest expectation of default between the projected defaults, the forecasted default rates, and your reversion rate. And it uses the highest, right? So it's looking at all these expectations of default, and it's going to pick the highest expectation of default, whether it's a forecasted value or a reversion rate. The other consideration in a PD model that we have to make for is loans that are already 90 days delinquent or greater. So, right, when we have loans that are current, we have this expectation they may go into default, right? What's the likelihood they may go into default? 2%, 3%, 4%. For loans that are already in default, there's no longer really that expectation, right? So we have to adjust the calculation to 100% expectation of default for those loans that are already 90 days delinquent or greater. So, right, if my highest let's say our highest expectation of default is 2.5%, all of my loans that are not delinquent severely are going to use that 2.5% expectation. But those loans that I have that are 90 days delinquent or greater, that are using 2.5% in the calculation, they're going to use 100% expectation of default. And they're going to get hit with a bigger allowance because they're already in default and there's no longer a probability that they'll go into default. They are in default. All right. The calculation here is very simple, right? We have our PD times our LGD, so our probability of default, our default expectation, 5%, our loss given default. We're expecting to lose 40% of the balance prior to charge off when we have to charge off a loan in this pool. And then we have our exposure at default. We multiply those three things and we get our expected loss under CECL. Now, I want to talk quickly about exposure at default. This is an important thing to consider in a PD model. The exposure at default is the expected balance of a financial asset at the moment of the highest expected default, right? So if I have a loan today, I know what the balance is. I know what its contractual paydowns will look like, but I'm not expecting the highest level of default until 18 months into the future. So at that point in the future, we're going to say, all right, what is the balance? What is the expected balance of this loan when it reaches its greatest expectation of default? And that's the balance that's used in the calculation versus the balance of the loan today. Now in ARCSys, we have two options. We can either allow you to use the balance of the loan today and the long-term average default rate, or you can project out further and you can use the expected balance or the exposure at default times our highest projected default and loss given default assumptions. One is a little bit simpler. It kind of gets rid of the forecast piece in a PD model. One builds in those forecasted values. It builds in the expectations of loans paying down through time, and it impacts loans differently based off of where they are in their life. Again, kind of getting back to this life cycle component, treating things differently by where they are in their life. But overall, the calculation here is very simple. Once you have those things ironed out, probability of default percentage times loss given default percentage times our balance, whether it's the current balance today or it's that exposure at default in the future. That equals our expected loss in a PD model. Now, and this is kind of what I was getting at here with the application. We have to consider 90 days past due loans differently, and you'll see that at the bottom here. So, right, when we have loans that are greater 90 days past due or greater, the allowance is very, very simple when calculated. It's the current amortized cost basis times the loss given default times 100% expectation of default. Okay. When we're doing this future expectation, right? So this is incorporating the exposure at default. So we're looking at how balances pay through time, and we're looking for that highest predicted value. The calculations get a little different. If I have a loan that's already been on the books, well, let's say a brand new loan just originated this month, it's going to look at the forecasted values, then to the reversion rate. And it is going to pick the higher of the two when looking at the probability of default expectations. It's going to pick the higher of the two defaults. So let's say my highest forecasted value for default is 0.5%. My reversion rate is 1%. It's going to use the highest, so it's going to use the reversion rate at 1%. Now, I'm not going to get to that reversion rate. Let's say I'm forecasting 24 months. I'm not going to get to that reversion rate till 25 months into the future. So that exposure at default would be the balance expected 25 months into the future when we start to run the actual calculation, right? So that EAD isn't my balance today. It's my expected balance 25 months into the future when my expectation of default is at its greatest. We'll flip the script here and now say, let's say we have a forecasted value of 1%, 12 months into the future, and our reversion rate is 0.5%. So our historical average is 0.5%. Now, instead of my reversion rate being the highest expectation of default, my highest expectation of default is in my forecast window, 12 months into the future. Now my exposure at default isn't 25 months into the future, it's 12 months into the future, right? That exposure at default is always the exposure at the highest expectation of default. So if my forecast window has the highest expectation of default, I'm going to use that EAD at that time. If my reversion rate is period of highest expectation of default, it may stretch out a little further. So we have this way to kind of, again, consider where loans are in their life, and the period zero expired term options that I was mentioning earlier can also be applied within a PD model, where you can build things differently based off of where a loan is in its life using the expired term option, or you can treat every loan the same using period zero and fill in the entire forecast period if you see fit. Current amortized cost basis option in a PD model, this is where we get rid of that forecasted expectation. We take your current amortized cost basis of the loan today, we multiply it by the loss given default, and then we multiply it by that long-term average inputs for your default. It removes the forecast, right? You're just using current amortized cost basis, loss given default, and historical average defaults that you're feeding into the model. The prior one we were looking at, future cash flow, this includes forecast. So future cash flow includes the forecast, current amortized cost basis excludes the forecast. All right, we're going to move into weighted average remaining maturity now. So this is our warm models. This is one of the simpler models, and this model may be good for smaller institutions or for less complex pools. A warm model is, if you think about what we used to do in the incurred loss model, where we came up with our annualized loss rate, you're basically doing that in a warm model too. The difference is, instead of using that annualized loss rate and applying it against the balance of the loan today and stopping, you kind of keep repeating that calculation, but into the future. So what we do is we still calculate an annualized loss rate. You can go, again, the standard says you need to pick a historical period that is representative of current risk. So you go find that historical period of charge-off risk that you think is reflective of your current risk. You calculate an annualized loss rate. You apply it to the balance of the loans today, but then you repeat it every year as the loans pay down. So instead of just saying, here's my annualized loss rate, go multiply it by the balance of the loans and being done, now you have to say, all right, I'm going to go multiply by the balance of the loans today. I'm going to go figure out what my expected balances are, including prepayment expectations 12 months from now. And then that just repeats till the loans pay off. So you're kind of just taking that annualized loss rate approach in the incurred loss model. And then to build in the expectation over the life of the loan, you're repeating that calculation on the expected balance of loans into the future every single year moving forward. So I think hopefully that helps people understand what a warm model does and kind of how it took a very simple calculation under the incurred loss model and expanded it to kind of fit the needs of CECL and estimating over the life of the loan. So again, you have your loss rate inputs. You do need your expectations of prepayments. Now, this can be done sometimes through some models use like weighted average life to build in kind of this prepayment expectation. Our models actually run at the loan level. So we just build in prepayment projections and reversion rates, just like we do in our discounted cash flow models. But we do use that annualized loss rate in the WARM model. Now, the one big thing and the biggest difference between a WARM model and the other models is the WARM model does not consider any forecasted values outside of qualitative factor additions. So you're not building in loss rates and then projecting loss rates. You are building in a historical average, and the historical averages is all that's used. So you do have a greater reliance on qualitative factors and specifically economic conditions and expectations in a WARM model versus the discounted cash flow or the PD models we were looking at earlier, right? Those models build in projected charge-offs, prepayments, defaults, whatever the dependent variable is, based off of what your economic forecasts look like. A WARM model doesn't do that. It does not build in expectations of charge-offs. It's strictly looking at your historical averages. So greater reliance on qualitative factors, potentially, and most certainly on forecasted impacts through qualitative factors within a WARM model, because they are not considered forecasted assumptions and not considered naturally within that WARM net charge-off reversion rate. It's just the historical average. There is no projection. What is the core loss estimate input for the WARM model? The predicted PD rate, a historically observed annualized net charge-off reversion rate, the average lifetime LGD, or the average prepayment speed. Very good. All right. The correct answer was B. Next, we're going to talk about dependent variables and the economic forecast impact of each of these variables depending on the methodology being used. We're going to first discuss charge-offs and prepayments and their interactions within a WARM model and the discounted cash flow models, whether we're using a life cycle discounted cash flow model or reporting period discounted cash flow model. First, we'll discuss the impacts of charge-offs within a WARM model. The historical periods selected in the model configurations within a WARM model end up being utilized to calculate an annualized charge-off rate. This rate is applied to the expected remaining balances over the life of those assets through time. Additionally, prepayment assumptions are also utilized in a WARM model in order to calculate the remaining amortized cost basis on each asset or pool of loan over its remaining life. One thing about the WARM model is economic forecasts are not captured within charge-offs. You're only utilizing that annualized loss rate of the historical data that has been applied. Therefore, Q factors are generally needed in order to capture any changing economic environments that will impact risk, making this model more reliant on qualitative factors in regards to economic forecasting. Within both the life cycle discounted cash flow and reporting period discounted cash flow model, again, historical charge-offs and historical prepayments will be input into the model. These models, however, will forecast specific charge-off assumptions and prepayment assumptions moving forward through time. The main difference is one is using vintage-based data and one is using that monthly reporting period. These models, utilizing economic forecast, do not have that heavy reliance on qualitative factor adjustments due to changing economic environments, as those economic forecasts are integrated directly into the charge-off and prepayment outputs, assumptions that will be utilized in these calculations. When we look at probability of default models, we have two main dependent variables. We have default and loss given default. Now, default can be measured by both dollars going into default or units or number of loans going into default. When the probability of default model is using dollars, the models project or forecast expected default rates in the future based off of the historical dollar defaults observed in the model inputs. Similarly, the units method will also do the same, but instead of using the dollars as the denominator, it will utilize the units or the number of loans going into default instead. For dollars and units, economic forecast will adjust the expected defaults throughout the forecast period. Again, allowing for less of a reliance on qualitative factors specifically for economic forecast components within a probability of default model. Loss given default, or LGD, is the other assumption that is used in a probability of default model. This helps an institution measure the loss severity upon default and is a core dependent variable within a probability of default calculation. Next, we will go over some of the similarities and differences between these different models. To start, let's discuss the similarities. In all models, the methodology must project the expected loss over the entire expected life of the financial asset. These models are all built on a historical foundation, meaning robust historical data sets are the best starting point as inputs into the models. Additionally, as the CECL standard requires, the aggregations of loans into similar risk pools must also be considered. Now let's talk about some of the key things that should be considered regarding the differences of these models, which will also allow us to determine which method may be an appropriate choice based off of the complexity and data available. The WARM model is the least complex of all of these models. These models can be built either using loan level data or some summary level data. The granularity that these can be performed at, again, can be done at the asset or summary level, meaning that loan level detail is not a requirement for the WARM model specific. With this said, understanding things like weighted average life and other aspects may still require some loan level detail and review at this level in order for key assumptions to be validated. The key variables within a WARM model are charge-offs and expected prepayments. This is the one model where the economic forecasts are not directly integrated into the model's assumptions and must be refined through the use of qualitative factors. Moving into our reporting period discounted cash flow models, this model is somewhere between a medium to high complexity. The granularity of this calculation is performed at the loan level, meaning loan level data is a requirement in the monthly calculations. Again, the key variables here are going to be charge-offs and prepayments, driven by monthly reporting period inputs. Economic forecasts are integrated into this model, and the data requirements are more demanding, requiring aggregated data by reporting period and loan pool for the input assumptions of the model. Lifecycle DCF and PD models are the most complex and require the most granular data. In order to produce vintage-based analytics, loan-level datasets are required for this model. This includes all historical periods for which the inputs will be fed into the model's configuration. Unlike a reporting period model where the history can be based on summary level detail, lifecycle models require loan level data for the historical periods. For a lifecycle discounted cash flow model, charge-off and prepayment rates are still the key variables, just like our reporting period discounted cash flow models. In probability of default models, we will need either the probability of default in units or dollars, as well as loss given default. Again, in these lifecycle models, economic forecasts are integrated into the projections, and due to the need for loan level data to produce these vintage analytics, the data requirements are the most demanding for the different lifecycle models, as the vintage-based history must be built based off of loan level data sets. Now, each of these models has their own unique benefits and situations they are best suited for. The WARM model is efficient, it's scalable, it's easy to implement. However, due to the lack of economic forecasting, may require some additional qualitative adjustments not required in some of the more forward-looking models. The WARM model is best suited generally for small community banks and credit unions between $10 million and $100 million in assets, or for small non-complex pools. These models perform excellently for stable, homogeneous portfolios, or when there's limited resources for complex data modeling. The key here is the stable historical loss data. Generally, WARM models do not perform well in portfolios that have changing risk environments with changing assumptions period over period. Reporting period models bring in that forward-looking economic sensitivity. This directly links loss projections to economic forecast over a reasonable and supportable period, which is crucial for anticipating losses based on current economic environment. These models are best for mid-sized to large institutions and are ideal for those institutions looking for something beyond WARM. They can also be useful for pools that do not have a significant amount of loan level detail historically. Lifecycle models provide precision based off of asset age and vintage period. They are highly granular, and this approach is an excellent method for regulatory alignment and demonstrating risk management maturity. These models are best suited for mid-sized to large institutions when they have a significant amount of loan level detail store where these vintage-based analytics can be built. Now we'll discuss a little bit about the implementation and governance of these models. Firstly, let's discuss forecasting. CECL requires reasonable and supportable economic forecast. As we have been discussing, WARM models do not directly integrate economic forecast. Therefore, qualitative adjustments must be applied in order to adjust the annualized net charge rate based off of the historical period input. This requires outside analysis outside of the methodology in order to adhere to the CECL standard. Discounted cash flow models and probability of default models integrate economic forecast and adjust their forward-looking forecasted assumptions based off of the changing economic forecasted environment. With CECL, there is now a stronger reliance on model validation, documentation, and accountability. Model validations require backtesting, which is comparing the model's predictions to actual outcomes, sensitivity analysis, which would be testing how key inputs and assumptions change based off of an adjusting economic forecasted. Regulators expect that these items are documented, data inputs have sources, there is quality without any material data issues, key assumptions, meaning the look-back periods for charge-offs, prepayments, defaults, etc., are all documented. And additionally, for qualitative factors that are applied within the model, management should have these well supported either through the use of analytics or through expert judgment. Every step from the data input to the final allowance calculations should be traceable to ensure the model produces reasonable and supportable results.